how I'm thinking about investing in 2026 and why. In today's video, I want to talk about how I'm thinking about investing in 2026, not in a hype-driven way, not in a short-term trading way, but in a clear, structural, big picture way. I read the comments, I read the messages, and I see the same questions coming up again and again. And honestly, they're good questions. People are asking, will the stock market keep going up in 2026? Are gold and silver already too expensive? Did we miss the opportunity? Is it too late? Should we wait for a crash? These are the exact questions investors ask at turning points. And what I want to do today is walk you through how I'm thinking about investing in 2026, and more importantly, why I'm thinking this way. Because successful investing is not about guessing headlines. It's not about predicting emotions. It's about understanding the system you're operating inside. And once you understand the system, the decisions become much clearer. The reality most people don't want to accept. Let's start with the simple reality that most people don't want to accept. The system is designed to inflate asset prices over time. That's not an opinion. That's not politics. That's not conspiracy. That's how the modern monetary system works. Right now, the Federal Reserve is making money cheaper, not more expensive. And whenever money becomes cheaper, asset prices tend to rise. Stocks rise, gold rises, silver rises, real estate rises. Anything perceived as a store of value tends to rise. This isn't speculation. It's math. And before we go any further, we need to talk about the single most important concept in financial markets, something most people never truly understand. Liquidity. Liquidity explained in plain English. Liquidity simply means how much money is available in the system and how easy it is to access. When liquidity is tight, borrowing becomes expensive. Lending slows down. Spending contracts. Asset prices struggle. But when liquidity is plentiful, borrowing becomes cheap. Money flows freely. Risk appetite increases. And asset prices rise. Here's the simplest way to understand it. Think of liquidity like water in a pool. When the water level rises, everything floating in that pool rises with it. When the water drains out, everything sinks. Stocks don't rise because companies suddenly became better overnight. Gold doesn't rise because it magically became more valuable. They rise because the water level liquidity has increased. And right now, the water level is rising again. Why the economy can feel weak while markets rise. This is where many people get confused. They look around and say, prices are too high. People are stressed. The economy doesn't feel strong. Things feel unstable. And they're not wrong about how things feel. But financial markets don't move based on how things feel. They move based on access to money. When liquidity increases, money doesn't sit still. It moves. It searches for returns. It flows into stocks, ETFs, gold, silver, and anything perceived as a store of value. That's why markets can continue rising even when the economy feels fragile. The stock market is not the economy. It's a liquidity-driven pricing mechanism. And once you understand that, a lot of confusion disappears. Interest rates change behavior everywhere. Now let's talk about interest rates. The Federal Reserve controls short-term interest rates. When rates rise, borrowing becomes expensive. When rates fall, borrowing becomes cheap. And cheap money changes behavior across the entire economy. Companies refinance debt instead of paying it down. Investors take more risk because cash yields less. Valuations rise because future profits are discounted at lower rates. This is why rate cutting cycles matter so much. And here's the key point for 2026. We are no longer in a tightening cycle. We are in an easing cycle. And easing cycles support higher asset prices. That doesn't mean prices go straight up. It means the long-term pressure is upward, not downward. The truth about money printing. Now let's talk about something that makes people uncomfortable, money printing. The Federal Reserve has restarted balance sheet expansion. They call it reserve management. They call it technical operations. But at the end of the day, it's money creation. They started with roughly $40 billion per month. And this already began. And you'll hear officials say, this is temporary. This is not QE. This is just technical. But markets don't care what it's called. Markets care about what it does. And what it does is inject liquidity into the financial system. More liquidity means higher asset prices. That's the chain. And that chain has never been broken. Why this liquidity won't stop quickly. Some people argue this won't last long, that the Fed will reverse course quickly, that this is just a short-term adjustment. But here's the problem with that argument. The system requires liquidity. The U.S. government runs massive deficits. Banks require reserves to function. Markets depend on stable funding conditions. Once the liquidity spigot is open, shutting it off too quickly risks breaking something else. And policymakers know this. That's why liquidity cycles last much longer than people expect. That's why balance sheet expansion happens in phases, not bursts. And that's why betting against liquidity has historically been a losing strategy. What happens to the dollar next? Now let's talk about the U.S. dollar. When interest rates fall and money supply increases, the dollar tends to weaken. Why? Because you earn less interest holding dollars. And because more dollars exist in the system, a weaker dollar supports higher prices for U.S. stocks, gold, silver, commodities. This doesn't mean gold is becoming more valuable. It means the measuring stick, the dollar, is losing purchasing power. If you own 1 ounce of gold, you still own 1 ounce of gold. The price rises because the dollar buys less. This is why precious metals tend to perform well during easing cycles. It's not ideology. It's arithmetic. Why policymakers don't want a strong dollar? This part surprises many people. The current system does not want a very strong dollar. A strong dollar hurts exports. It tightens global financial conditions. It stresses debt markets. It slows economic growth. A moderately weaker dollar acts as a release valve. It supports growth. It helps manage debt loads. It makes financial conditions easier. Dollar weakness is not an accident. It's a feature of the system. The Fed put why markets get rescued. Now let's talk about something every investor must understand: the Fed put. If markets fall sharply, what happens? History tells us the answer. 2008, 2009, banking stress events. The Federal Reserve steps in, they cut rates, they inject liquidity, they expand the balance sheet. Why? Because market crashes don't stay in markets. They spread to credit, to jobs, to housing, to consumer confidence, to government finances. At that point, the cost of not intervening becomes greater than intervention. That's what people mean by the Fed put. It doesn't mean markets can't fall. It means major declines trigger policy response. Why the system is more fragile than ever. The reason the Fed put exists is simple. Debt levels are higher than ever. Markets are more interconnected than ever. Stress spreads faster. Damage compounds quicker. That means policy responses must be faster and larger. This is the environment we're in. A major shift coming in 2026. Here's something many people are overlooking. In May 2026, there'll be a new Federal Reserve chair. New leadership almost always brings a shift in tone. Historically, that shift is toward easier policy, not tighter. Why? Because policymakers want growth. They want stability. They want strong markets going into elections. They want to run the economy hot, connecting the dots. So let's connect everything. Rates are falling. Liquidity is rising. The dollar is weakening. The Fed stands ready to intervene. In this environment, asset prices benefit. Not in a straight line, not without volatility, but dips get bought. My personal investment approach for 2026, here's what I'm doing. I'm staying invested. I'm not sitting in cash losing to inflation. I'm not waiting for a crash that may never come. If markets dip, I buy the dip. People ask how much higher markets can go. My question is simpler. How much more money will be created? And are they stopping anytime soon? If the answer is no, then markets don't need to come down. Closing thought, part 1. Fear feels logical at highs, but liquidity doesn't care about fear. Liquidity drives markets. And until that changes, the path of least resistance remains upward. How to actually position your money in 2026. In part 1, we talked about the system. We talked about liquidity, interest rates, money creation, the dollar, and why asset prices are structurally supported going into 2026. Now we move into the part that actually matters. What do you do with your money? Because understanding the macro picture is meaningless if you do not translate it into action. Knowledge without execution is just entertainment. So in this part, I want to walk you through how I think about positioning capital in 2026. Not as a trader, not as a speculator, but as an investor operating inside a liquidity-driven financial system. First, we need to eliminate the biggest mistake investors make during easing cycle. That mistake is waiting. People convince themselves they are being patient, disciplined, and careful. They tell themselves they are waiting for better prices, more clarity, or confirmation. But what they are actually doing is letting fear dress itself up as intelligence. Markets do not reward people who wait for comfort. They reward people who position themselves correctly before things feel obvious. Liquidity-driven markets rarely give you perfect entry points. Instead, they grind higher. They frustrate cautious investors. They create endless reasons to stay on the sidelines. And then, years later, people look back and realize the opportunity passed quietly while they were waiting for certainty. The goal in 2026 is not to time the market perfectly. The goal is to stay positioned while managing risk intelligently. Now let's talk about cash. Cash feels safe. Cash feels responsible. Cash feels like control. But in an easing cycle, cash is a silent loser. When interest rates fall, cash yields less. When money supply expands, cash loses purchasing power. When asset prices rise, cash falls behind everything else. Holding some cash is reasonable. Overweighting cash because you're afraid is not. In a liquidity-rich environment, cash is not protection. It is erosion. Most people do not realize this until years later when they discover their money technically survived, but their purchasing power did not. Now let's move to stocks. One of the biggest misunderstandings in investing is the obsession with valuation during easing cycles. People argue endlessly about whether the market is expensive. They compare price-to-earnings ratios to past decades. They point to charts and statistics. Valuation matters long-term, but liquidity dominates medium-term outcomes. When money is cheap, companies refinance instead of deleveraging. Buybacks increase. Investors take more risk. Multiples expand. Markets do not crash simply because they are expensive. They crash when liquidity dries up. And in 2026, liquidity is expanding, not contracting. That is the foundation of the entire strategy. Now let's talk about the difference between growth stocks and value stocks. In tightening cycles, value tends to outperform because cash flow today matters more than promises tomorrow. In easing cycles, growth tends to outperform because future earnings become more valuable when interest rates fall. Growth stocks are essentially discounted future cash flows. When discount rates fall, those future profits are worth more today. That does not mean chasing unprofitable garbage. It means favoring high-quality growth with strong balance sheets, recurring revenue, pricing power, and low refinancing risk. These businesses benefit the most from falling rates and abundant liquidity. At the same time, most investors overcomplicate stock selection. They jump from idea to idea. They chase narratives. They rotate constantly. But history shows something very uncomfortable. Broad exposure consistently outperforms most individual stock-picking strategies over time. Index-based investing works because it captures liquidity flows, reduces single company risk, benefits from passive inflows, and removes emotional decision-making. In liquidity expansions, money flows into vehicles first. Indexes, ETFs, and broad exposure products absorb capital before individual stock selection matters. That is why ETFs remain one of the most powerful tools going into 2026. Now let's talk about volatility. Most people think volatility is risk. That is backwards. Volatility is how opportunity appears. In liquidity-rich environments, pullbacks are usually temporary dislocations, not structural breakdowns. They feel scary in the moment, but they are often caused by positioning, sentiment, or short-term fear, not fundamental collapse. That is why dips get bought. Not because investors are reckless, but because capital has nowhere else to go. Once you understand this, Pull back, stop feeling like danger, and start feeling like part of the process. Now let's talk about gold. Gold is not a growth investment. Gold is a monetary asset. Gold performs best when real interest rates fall, the dollar weakens, liquidity expands, and confidence in fiat currency erodes. That describes the setup for 2026 perfectly. Gold does not require economic strength. It thrives on monetary excess. Asking whether gold is too expensive misses the point entirely. The correct question is whether the monetary system is becoming more disciplined. And the answer is clearly no. Gold does not need a crisis to perform. In fact, gold often performs best during slow, controlled currency debasement, not sudden panic. It does not explode overnight. It grinds higher quietly. It preserves purchasing power while cash slowly fails. That is why gold belongs in a portfolio as a position, not a trade. Silver is different. Silver is more volatile. Silver has industrial demand. Silver behaves like a leveraged version of gold. When gold moves, silver often moves more. But that comes with deeper drawdowns and sharper swings. Silver performs best during liquidity expansions, but should be sized carefully. It is not a replacement for gold. It is a complement with higher risk and higher potential reward. Now let's talk about ETFs more deeply. ETFs are not exciting. They are not flashy, but they are extremely effective. They allow instant diversification, reduce emotional mistakes, capture sector-level trends, and align portfolios with how institutional money actually moves. In 2026, ETFs benefit directly from liquidity flows. Large pools of capital do not chase individual names, they flow into structures. That makes ETFs structural winners in easing cycles. One of the biggest return killers for investors is overtrading. Buying feels productive. Selling feels smart. Constant action creates the illusion of control. But most trading activity adds no value. In liquidity-driven markets, exposure matters more than activity. Staying invested beats being clever. Now let's talk about risk management. Risk management does not mean avoiding losses entirely. That is impossible. Risk management means survivability. Position sizing matters. Diversification matters. Time horizon matters. If positions are sized correctly, volatility becomes manageable. If diversification is adequate, no single event destroys the portfolio. If time horizon is long enough, noise becomes irrelevant. This is how professionals think. Waiting for certainty is another trap. People tell themselves they will invest once things are clearer, but clarity always arrives after prices move. Markets move first. Narratives follow. By the time certainty exists, the opportunity is already priced in. That is why disciplined investing always feels uncomfortable in real time. Inflation does not scream. It whispers. It erodes. Slowly, quietly, relentlessly. Every year you hesitate, your purchasing power shrinks. That is why the biggest risk in 2026 is not volatility. It is inaction. Here is the mindset so far. Stay invested. Avoid excessive cash. Use volatility strategically. Hold real assets. Think in years, not weeks. This is not about prediction. It is about alignment with reality. Liquidity does not care about fear. It does not care about headlines. It does not care about opinions. It flows where it is allowed. Before you click away, I want to leave you with something important. Not about markets, not about charts, but about mindset. Because investing is not just about numbers. It is about behavior. And behavior is what separates people who build wealth from people who stay stuck. If there is one mistake I see over and over again, it is this. People think the biggest risk is being wrong. It's not. The biggest risk is being inactive for too long while the system keeps moving. Most people wait for permission. They wait for certainty. They wait for the perfect signal that never comes. And while they're waiting, inflation keeps working. Liquidity keeps flowing. Asset prices keep adjusting. The system does not pause just because you feel unsure. I want you to understand something clearly. Feeling uncomfortable does not mean you are doing something wrong. In investing, discomfort is often the price of admission. If you wait until everything feels safe, clear, and obvious, you are usually late. That does not mean you should be reckless. It means you should be thoughtful. There is a difference. Thoughtful investors build plans. They spread risk. They think in years, not days. They understand that volatility is normal and uncertainty is permanent. Reckless investors chase excitement. Thoughtful investors respect probability. You do not need to predict the future to succeed. You just need to avoid obvious mistakes. You do not need to catch the exact top or bottom. You just need to stay aligned with reality longer than most people can tolerate. And reality right now is simple. Money is losing purchasing power. Assets are the defense mechanism. Time is either your ally or your enemy, depending on how you use it. One of the most damaging habits you can develop is constantly second-guessing yourself, buying something and then panicking at the first pullback, selling and then regretting it when prices recover, jumping from strategy to strategy because emotions are louder than logic. Wealth is not built through brilliance. It is built through consistency. The market will test you. It will test your patience. It will test your confidence. It will test your ability to sit still when everything inside you wants to react. That is normal. What matters is whether you let those emotions control your decisions. Before we wrap up, let me say this. If this video helped you think more clearly about investing in 2026, if it gave you perspective instead of hype, then please take a second to support the channel. Click the like button. It helps more than you think. And if you want more long-form, no-nonsense breakdowns like this, please subscribe to the channel. I read the comments. I pay attention to your questions. And I build future videos around what you actually want to learn. New videos like this are coming. And the goal is simple: to help you understand how the system really works so you can make better decisions with your money. Thank you for watching. Thank you for the support, and I'll see you in the next video. Take care.